If you're a realtor and you ever had a year where you made good money and then tax time showed up like a surprise bill you didn't order, this is for you. Today I'm sharing 4 tax tips every realtor needs to know because I see it all the time. People closing deals, building a brand, working like crazy, and accidentally donating thousands of dollars to IRS. Big heads up, I'm keeping this general because everyone's situation is different, but you are going to walk away with the practical moves that you can apply. And if you want realtor tax write-off checklist, just comment the word realtor and we will send it to you. Even if you're watching it on the replay, do it anyway. Okay, let's jump in. Tip number 1, mileage equals money. If you're driving to showings, closings, inspection, meeting clients, running to home goods for a last minute, this house needs a wipe fix, that mileage can turn into a real deduction. And here is the painful part. Most of you people, of you guys, are driving a lot, but not capturing it. So it's like losing cash in tiny little increments every single week. Simple. Start tracking your business miles consistently. I love mileage apps because they make this almost automatic. Mile IQ is one app that we recommend. The standard mileage rate changes year to year, but the point is the same. Every legitimate business mile you track can reduce taxable income. And the IRS doesn't want, I think it was about, they want a clean log. So if you do one thing after this live, make it this. Pick up an app like MileIQ, turn it on and build the habit. Also, quick clarity that saves people stress. Commuting from home to your regular office doesn't count, but going from your home office or from your regular office to showings, meetings, networking events, broker training, inspections, and anything business related absolutely can. And here is the little mindset shift that I want you to take. Don't treat the mileage like an extra. For many realtors, mileage is one of the biggest deductions available, but only if you document, so please do. Tip number 2, home office can be a hidden goal. Now, I know this one gets people nervous because they have heard rumors like home office is an audit trigger. Let me calm that down. The home office deduction is real and allowed, but you have to do it correctly. The big rule is that space must be used regularly and exclusively for your real estate business. So if it's the kitchen table where the kids eat and you also answer emails, that sometimes in the same place, that's usually not the one. But if you got a dedicated corner, a space that's clearly your work zone, where you do your admin, marketing, contracts, client follow-ups, planning, and running the business, you may be able to deduct a portion of certain home costs. And this is where people miss money. It's not just the obvious stuff. Depending on your situation, a portion of rent or mortgage interest, utility, internet, even some repairs that relate to the space, to that space where you work, can be part of the equation, even if it's just a corner. It can count as long as it's truly dedicated and you can support. Also, if you own your home, you can deduct depreciation expense. This is the expense that you have not even incurred. It's a paper expense, but you can deduct it as business expense and reduce your taxable income if you have home office. My practical tip here is super simple. Decide what your home office space is, keep it consistent, and document. Take a quick photo today, measure the square footage, keep a note of how you use it. This is how you turn I heard about the deduction into yes, we claim it and we can back it up. Tip number 3, market like a pro, deduct like a boss. Realtors are marketers. Your business is visibility, trust, relationships, and staying top of mind. And the tax code actually understands that. A lot of the things you spend money on to build your pipeline can be deductible business expenses, but only if you're tracking them and categorizing them properly. So think about your signs, your ads, your photography, your video content, your website, CRM, your lead generation tools, flyers, promo items, and yet even open house snacks. That stuff can be part of doing business. The biggest mistake I see that is not that people don't spend money, is that they spend it and then it disappears into a personal card statement and never becomes a clean write-off. Let's also talk about client gifts for a second because people love this one. There are limits and rules, so you want to be careful and intentional, but gifts can be deductible within the guidelines. The key is receipts and notes. If you buy a closing gift, keep the receipt and make a quick note of who it was for and what closing it relates to. Same with open house expense, same with signage, same with branded materials. And here's a tiny habit that saves thousands. Once a week, take 10 minutes and categorize your expenses, because if you wait until tax time, you will forget what half of it was. And you either underclaim or you'll be guessing, and neither one feels good. Tip number 4, make S-corp moves. This is the one that can be a huge lever for the right situation, and it's also the one that people hear about on the internet and sometimes do it at the wrong time. Here's the simple version. When your profit gets to a certain level, and it depends, an S corporation can potentially help reduce self-employment taxes by splitting income into a reasonable salary plus distribution. That can mean real savings, but it's not automatic. It's not for everyone, and it should be at the right time. There are payroll requirements, extra tax filings, and you need a clean bookkeeping to do it right. So the way I explain it is like this. If you are consistently profitable and you are starting to feel like tax are taking an aggressive bite of your success, this is a conversation worth having. Not a let's do it because TikTok said so thing, but a real let's run numbers and see if it makes sense for you strategy. Also, quick reality check. S corporation savings not aren't the only goal. The real goal is keeping more of what you earn without creating a messy setup that makes your life harder. Strategy should simplify your life, not complicate it. Now, I want to add one bonus thought that ties all 4 tips together, because this is where realtors win. Tax savings aren't just about deductions, it's about the system. When you have a simple tracking system for mileage, a clear setup for home office, clean documentation for marketing, and the right entity structure when the time is right, tax season stops feeling like a surprise attack and starts feeling like a planned business moment. And that's exactly why I have a Realtor tax write-off checklist for you, as I mentioned before. If you want it, comment and we will send it to you. If you're watching this on replay, comment anyway, grab it, use it, and the next time you are spending money in your business, you will know whether it's just an expense or a smart, documented, tax efficient move. Before I hop off, here is the question I want you to ask yourself tonight. If you had to prove every deduction you are planning to take, would you feel confident? If the answer is that's not a judgment, that's just a sign you are ready for a better system and we can help. If you want us to take a look at your numbers and show you what's missing, send a message and we will get you the checklist and next steps. All right, friends, go save some money and I will see you on the next one.